Hello and welcome to Getting Started with Traditional Commodities and Futures, Part 2 of 2, Section A. My name is Noble Dracone. I'm the author of the books Futures for Small Speculators and Single Stock Futures for Small Speculators. I'm also the Senior Analyst and President of Liverpool Derivatives Group Company, where our focus is on the needs of the trader, not on the trading. Now, before we begin, I believe it's important to let you know that unlike many futures and options promoters, I'm actually a licensed professional. I'm also a member in good standing with the National Futures Association and registered with the CFTC. So what my focus is in doing these seminars is to really lift the curtain on some of the inherent concepts and behind the scenes of traditional commodities and futures, and what makes them different from their better known stock counterparts and how those operate, and kind of leave out a lot of the hype that typically goes with futures and options investing. Let's begin. Now, here's our risk disclosure once again. Futures is not for everyone. Only use capital that you're capable of risking or potentially losing, and the information provided here is particularly for informational purposes, and seek the advice of a tax or professional or stockbroker before making most investment decisions, especially in this arena. Getting started with traditional commodities and futures this is the second part of a two-part series, and it's actually divided up into a Section A and a Section B. And I'll explain to you in a moment why this happened. Now, what we'll cover in this half of the seminar are three core areas. First, we'll have an in-depth discussion of futures contracts, and we'll explain pricing and hedgers and speculators and how futures contracts actually work in the real world. And then we'll go into an introduction of some of the trade management tools we use in-house to trade. And then lastly, we'll talk about analysis of futures charts. Now, when I put this seminar, the second half of the seminar together, we ended up with about 90 slides. And of those 90 slides, about half of them really dealt with the analysis of the futures charts. So we divide the second seminar up into two parts. Section A, in which we'll cover the futures contracts and we'll introduce some of the trade management tools. And then we put the second half of the slides and of the analysis of the futures charts on a Section B to give you an opportunity to really focus on Section B in the next seminar that you'll be seeing after this one. Let's begin with the discussion of futures contracts. Now, in understanding how futures contracts work, we'll first decipher what goes into a futures contract and how it differs from these typical stock investments that people make. And then we'll talk about how futures contract pricing really evolves and how it's developed and how the hedgers and speculators play core parts in creating that. And then we'll also talk about various reports of supply and demand, because unlike most investments, futures and traditional commodities really focus on what people want and how much of that is actually available. Now, when we're deciphering a futures contract, we'll cover about 7 core areas. We'll first talk about identifying the players that invest in the futures contracts. We'll then talk about the true volatility of futures contracts. And then we'll talk about your obligations as a futures contract holder, which completely differ from many stock investments. Futures contracts are actual binding contracts and agreements that put you on the hook for certain things, and it's good to understand what those things are. We'll then specify what goes into a futures contract, and then we'll talk about how each contract has their own set of margins and has their own set of trading months, and how you can actually trade those months and those margins for investments that you particularly like. Then we'll understand notice days and delivery dates. Since futures contracts do have expiration, understanding when these contracts expire can be very important to your investment making decisions. And then we'll tie all this together and come up with some ideas or discuss some ideas on how you can use this information for your own speculation in the futures and traditional commodities market. The players. There are 2 core players when it comes to futures. That is hedgers and speculators. Hedgers are the ones who use futures as an insurance vehicle. As we discussed in the first seminar, futures was originally created as an insurance vehicle for producers of corn, wheat, and agricultural products. And to this day, it still has that effect, even though most futures deal with financial instruments. And some of the players in the hedging side of futures are ABN AMRO Inc. They're a major agribusiness corporation that has operations throughout the world. Domestically, they own all types of farms and processing and packing plants, as well as Deutsche Bank Securities Inc. They use hedging because recently we've seen the euro currency go up tremendously, and so they use bonds to protect their investment portfolios in the euro market. And then we have Barclays Capital Inc., which is a huge hedger in the business, futures business, and you have Goldman Sachs. And as you can see, Deutsche Bank, Barclays, and Goldman Sachs are well-known corporations in the stock side, but few people know that they have just a strong influence in the futures market. And then most Fortune 500 companies actually participate in futures. The other day, my son and I were talking about investing in Nintendo and what Nintendo was doing, because he had bought a new Game Boy SP for Christmas. And when we were looking through the annual statement for Nintendo, they had a huge section in their annual statement devoted towards derivatives and how they make their derivative trading decisions for currencies and product risk. So futures plays an integral part in especially the global economy for major corporations. Then there's the second category of people, which are the speculators. And the speculators actually fall into two levels. You have the large speculators. One group of large speculators is Cantor Fitzgerald and Company. They're based in New York, and very huge company. They have large influence with the market. They get investors to come in through a lot of their managed trading programs and convince people to invest with them. Very strong. And the reason why they're large speculators is because of reporting requirements that we'll discuss a little bit later that major corporations and companies have with speculating in futures. Bank of America, large banking institution, has a futures division, and they have a portfolio in which they trade futures. Again, futures is an integral part of today's global economy. Then you have the small speculators as a second group, and that's where typically you and myself fall in as investors. Small speculators don't have to report their positions to the government, and they provide some of the liquidity, if not a large part of the liquidity necessary for the hedgers and the large speculators to operate. Now, it's very important to understand that futures are obligations and not ownership. Futures have a unique role in the fact that they are not an investment that most people would think of. Many investments typically fall in the category of buy and hold, such as you buy stocks, and lately more people day trade and do swing trading, but it still falls into the idea that you can actually hold a stock for a lifetime. You also have bonds, which you can hold for a lifetime. Well, futures actually have finite time frames in which they fall under, and so their life cycle is shorter, and that's why when we talk about it, especially when I talk about it, I talk about more about speculating in futures and less about investing in futures. Now, the first problem with futures, or the first issue with futures, is that the contracts have to be offset before expiration, because when they expire, you have to make or take delivery of the contract. So if you happen to have a coffee contract or a live cattle contract, because that's been in the news lately because of the mad cow disease, if you're holding a contract into expiration, you end up having to make delivery on it or take ownership of it in some form or fashion. And so there are specific rules associated with those interactions. One other thing that makes futures unique is that it's marked to market. And what this means is when you hold a stock and as it starts to accrue in value, say going from $20 to $25, the only way you can realize that capital gain of $5 is by selling the stock. Well, futures is a little bit different. As you go from $20 to $25 and $25 to $30, the actual amount is being put into your account in real time, so that the value of your account is going up or going down at the same time that the futures is moving. And so you have access to the capital that you've made, or you have access to the capital that you've lost immediately.